This is my financial disclaimer so I don't get sued. Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. I'm going to be going over the data sets, the earnings, the SPY technical analysis, having a discussion about the yields, including the labor market and the long-term trends, going over Bitcoin, DXY, and potentially some other symbols like HYG. Um, Maybe some other stuff. So, this week will be a shorter week. It is Thanksgiving week, so Thursday will be off, and Friday will be a shorter trading session. So, that's what I'll be going over for the week of November 24th, 2025. And with that said, let's go ahead and jump straight into the data. Now, this is going to be a bit of a longer video, I believe. It's quite a bit I do want to talk about. So, for the data section and at least the technical analysis section, I will be going over those hopefully a little quicker than usual, so that we can actually get to the discussion about the treasury yields. So, with that said, uh, we do have a shorter week this week. Again, Thursday there will be data, no trading, and Friday the market closes early, so it closes at 1 p.m. With that said, on Monday, we do have industrial production data. I don't really anticipate this to move the market too much. That's at 9:15 a.m. But we do have the 2-year no auction at 1 p.m. Now, again, I don't really expect this to move the market much either, but this one's going to be very key to look at. Again, as we start really honing in on what the real narrative is going on with the market, with the economy, everything else. It's very important to be paying attention to, especially the 2-year yield and the 10-year yield. The 2-year yield is the treasury yield that the Fed watches the most. And thinking about cycles, the 2-year is halfway through a presidential cycle. It really prices in a lot within that 2-year range. So it's a very good yield to look at. Now, with that said, um, we did have the 20-year auction come in quite high last week. It came in at 4.7% when the previous auction was a 4.5%. Now, I have not gone through the actual 20-year auction data. That yield pushing up could be due to many different reasons. But I'm not going to, glaze over that or anything. Uh, it was a higher yield, and that's not good. So when we have that yield coming in higher, we definitely want to be paying attention to these treasury auctions that are less of a duration. So the 2-year yield is going to be telling us quite a bit, especially after hearing the FOMC meeting minutes last week, getting some of the labor market data, all that good stuff. So seeing how the market reacts in the 2-year yield will be very key. Will we see this push down further towards that 3.4%, or will we see this start to actually pick up a little bit? Um, that's really, a major concern, or not really a concern, but really something I want to determine is what's going to be happening with this 2-year yield in the short run. Now, Tuesday, we do have, let's see, the ADP weekly employment change. Now, this is a new data set. I believe this is going to be the fourth print, if I remember correctly. So just be aware of that this is kind of a new data set we have to be aware of. Um, but it does help a lot with not just figuring out what's going on with the labor market and everything, but when we have this ADP employment data coming out every week, along with the continuing jobless claims and um, the initial jobless claims, it's really beneficial to see different agencies targeting kind of the same thing. Um, and give you a much clearer picture overall. So That's at 8:15. That's going to be very, very important. We have the core PPI and the core retail sales, also PPI month over month for September. A lot of September data coming in here at 8:30 a.m. on Tuesday, so that's going to be a very important time frame as well. Let's see. Consumer confidence is at 10 a.m. That's going to be very, very important. And if I remember correctly, I think I have this pulled up, and I wanted to show this chart because there's a major correlation. I could stop getting ads. There's a major correlation between this CB consumer confidence chart and kind of what goes on with the market. So going over a 5-year time frame, and while this doesn't look very impressive, this reflects some of our sell-off times. Um, if you look at, let's see, there was that July correction in 2024 right there. There was the big February to April correction this year. Um, Now we're seeing this again starting to pull back down, and every time this pulls down, and this is why I had this on the max time frame, that's not a good thing. This correlates very, very, very directly with um major sinks in the market. So um I thought it was interesting. I was just kind of looking over that, and it's kind of shocking to see how much this aligns with the S&P, with major corrections, everything else. If you can actually put this CB consumer confidence chart uh, next to the SPY, I think you'd be extremely surprised at how accurate this follows. So this consumer confidence is very, very, very crucial. I think that it's a much bigger data set than any of us have really been paying attention to. Um, they're expecting that. The forecast is expecting that to come in weaker. That should be a good thing for the market, actually, because that should be pricing in a rate cut rather than a pause or anything else. And we will go over the CME in just a couple minutes here to show you what the rates are expected to be and everything. But I am still massively in the boat that we're going to be getting a 25 basis point cut for December. Um, I know that the CME has that priced in a lot less, but I believe that the Treasury market and everything is telling us that we will be getting a cut. Um, okay, so that's 10 a.m. consumer confidence. Again, that's super important. That's a very, 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 very crucial data set right now. Atlanta Fed GDP, that's still been coming in quite high. Just to kind of put that in perspective again, over the last 6 months, that has pulled from a 2.6% to all the way to this 4.2%. So, it has been a very, very substantial, increase over the time frame. So, not a super important data set, but it has been showing that the Atlanta Fed is seeing a increase in the GDP now. Again, I'm not sure if this is because of the tariffs and everything else. It could massively be due to the tariffs. I'm not sure. We have the 5-year note auction at 1 p.m. Sort of the same reason. The 2-year note on Monday is going to be very, very important. But obviously, the 5-year isn't going to be as crucial as, say, 10-year or the 2-year, but it still tells us a 5-year duration. It still gives us, that middle ground between the 2-year and the 10-year, even though the 7-year is more widely looked at for that. But again, this is still going to be telling us what's going on with the yields. Are we going to be seeing the yields pulling down with these auctions, or are we going to be seeing these final auctions um, pulling the yields up? And remember, these are some of the final auctions we're going to be having right now. Uh, you, quantitative tightening is ending on December 1st. Now, Wednesday, November 26th, this will be a full trading session. This trading session doesn't end early. Just be aware of that. With that said, at 8:30, we have quite a bit of data sets. We have GDP quarter over quarter. We have core PCE prices. The jobless claims will be coming in on Wednesday instead of Thursday because obviously Thursday is closed. Um, very important time frame at that 8:30 mark. At 10 a.m., we have the core PCE price index, the month over month and year over year. We have the new home sales, uh, personal spending. Very important time slot as well. Out of any of the days this week, really Wednesday's the big day. And then we have the 7-year note auction at 1 p.m. And this one is important compared to, the 5-year auction. This one will show a lot closer to the 10-year rate and what they're really anticipating out of that. So I am very excited for the 7-year auction. I am expecting the yield to pull downward towards the 3.6%. But again, we will see. At 2 p.m., we have the Fed's Beige Book. I know many do not read that, but it comes out once a month. And it's very crucial for telling what's happening on the ground. And what happens with these beige book reports is the Fed in each of the different Fed districts goes out to local businesses and they, ask everybody a series of questions to determine what's happening with the customers, what's happening with hiring, if they're firing, etc., etc. It tells you a very major story of what is really happening with the labor market and then what's happening with the consumer economy and everything else. So for me, it's one of the most important data sets you can read, but I know majority of the market largely ignores it. I would highly suggest reading it, even if you just copy and paste it and put it through an AI. It's better than nothing. That comes out again at 2 p.m. on Wednesday. Thursday, again, is closed. Happy Thanksgiving. I hope you all spend that with your family or friends and be able to enjoy the day. On Friday, it will be a shorter session. The day ends at 1 p.m. But we do have the Chicago PMI at 9:45 a.m. That's really going to be the most important and only data set for the day, unless for some reason President Trump or something happens outside of the data sets. So, um, busy week. We have a lot of data really happening in 2 sessions. It's really quite packed for the Tuesday and Wednesday. And over the next few weeks, we should really be expecting these data days to be pretty packed because we're not just getting current data, we're getting previous data as well. As you can see, a lot of this data is the September data, August data, October. So you have a wide mix of data sets coming in here. And again, very likely over the next month, we're probably going to see a lot of this happening. So just be prepared for a lot of these kind of crazy data days. And the way to do that and the way I do that is looking at the time frames. So that's kind of how I set my day up, you know, how I set my trading session up is if, for example, the 8:30 time frame is very important. I will be waiting for that time frame for all the data to hit before I enter or exit any major trades, unless I'm planning to exit trades or, you know, etc., etc. Um, Same for the 10 a.m. time frame. Have a lot of data that's, very crucial coming out at that time frame. I will slow down my trades at that time and wait for the data to hit and move on, after the data comes in. So, um, just trade it time frame by time frame rather than each and every data set, and it will probably be a lot easier for you to, handle these massive data days. We will be talking about some of the data again in just a couple seconds here, but I wanted to go over the earnings because that part of the discussion is going to be for the yield topic, or the treasury slash yield topic. But for the data this week, let's go through it. So for Monday, We have Zoom, not really interested in that. FLNC. Um, I actually still have some of my Fluence Energy shares, which have been absolutely killing it. We bought into this between the $5 to $8 range, and I believe it's like $17 through $20 right now, last I checked. So it's been doing really good. I'm very happy about it. Yeah, I don't really care about the earnings though on it. I think the company is just in a great place to pick up a lot of weight. So, yeah, that's for Monday. Now for Tuesday, nothing really big that I can see. There's Zscaler, which that's fun. Um, that's moved a lot. Dell. I know some people play Dell. I personally don't. A little bit of somewhat techish earnings on Tuesday, but nothing really major. Um, At desk or Autodesk doesn't really matter too much. Yeah, not a very interesting week for earnings, unfortunately, but that's always okay. We do have a lot of data this week, so having a little bit more of a relaxed week in terms of the earnings is totally okay with me. I know that we had NVIDIA last week, so um, I can relax this fine. If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime. All right, and getting into the technical analysis for SPY, as always, let's turn on our daily time frame. Let's turn moving averages and the Bollinger Bands, and let's dig into it. So on Friday, we did have our lower Bollinger day 2, and just very quickly going over the mechanics of that. Lower Bollinger day 1, we expect to close at or below the lower Bollinger. For day 2, anticipate a lower low into bull structure and slow consolidation back up to the 5 mile. Now, slow part was not so much. Yeah, we did have a 5 mile test on Friday as well. We had our day 2 bottom Bollinger move into the 5 mile push, and just very quickly looking over the 2 hour time frame, you could see how we had that push to the 5 mile right there. During that Friday session, we pushed upward, tested the upper bounds of the 5 mile, came back, tested the lower bounds, and basically closed almost right at the 5 mile itself. So we did officially have the 5 mile test. Um, with the market being very slightly above it, can retest that area again. Um, and I will kind of preface this with this week having Thanksgiving and then Friday being a shorter day. Very likely the volume this week is going to be very low. Um, that doesn't always translate into continued selling. Sometimes the low volume days/weeks are some of the largest buying times. Um, yeah, so just be aware of that. Um, from the 5 mile test, uh, generally that's a slower consolidation up to that 5 mile. Usually I expect that to happen on day 3 or day 4 of that lower Bollinger move. Generally, I don't really anticipate it on the second day. With it happening on that day 2, I really do have the anticipation that it's going to sit at that level for another day. If it doesn't, then remember, from this 5 mile, with it being underneath the 20-day moving average, that means that with the 5 mile tested, the market can come back and retest the 20 mile. Okay. Because from that 5 mile test, either you're going to start heading back up to the 20 mile, or you're going to head back down into the lower Bollinger. Now, with us having basically two back-to-back lower Bollinger moves, we had the lower Bollinger move in here, tested the 5 mile. From that 5 mile test, we went right back down into the lower Bollinger, had that second lower Bollinger move, and the 5 mile test. Okay. My real expectation should be that we should see the market slowly consolidate back up to that 20 mile range. However, we did have a 20 mile test not that long ago, and because we had a 20 mile test not that long ago, technically we truly do not need to test the 20 mile for almost a whole nother 2 weeks. So we can sit at this level for quite a bit. Um, Sorry, I'm just taking a look at this. Now, one thing we did discuss last week is how the moving averages currently they're in a short-term bearish trend. Okay, we have the 5 mile finally pulling underneath that 20 mile with some conviction. We have the 10 mile underneath the 20 mile, and we have the 20 mile above all those moving averages slowly pulling towards that 50 mile. Okay. We will have the 10 mile pulling under the 50 mile as of Monday. Monday is open. So we now have two of the three short-term moving averages underneath the 50-day moving average. So things are slowly starting to get more and more bearish as each session passes. The 50 mile will be pulling down much, much slower than the 5 mile, 10 mile, and 20 mile. So just keep that in mind that if buying does not pick up very soon here, that our moving averages are going to sink down very, very quickly. Now, with the 5 mile being pulled down so low, with the market price being pulled down so low, 20 mile will be pulling down very quickly. And with the 20 mile moving downward, we will start to see the lower Bollinger opening up to the downside very aggressively, and we will see the upper Bollinger start to curve to the downside very aggressively. So you should really be anticipating that probably over this next week to really see these pulling down quite aggressively. Even if we had buying all the way back up to the 20 mile, I don't think that'd be enough to shift the course of the moving or of the Bollingers just yet. So really anticipate this lower Bollinger starting to open up this next leg down. Towards that 627 range. I know that kind of scares a lot of people, but um, this consolidation is to basically open that downside more. With us being in the bearish trend and everything, it's not wise to just anticipate that we're going to start buying upward. Um, with that said, though, I'm going to turn off the moving average, and I do want to point out that the lower Bollinger is always the major buying ranges. Okay, so even though I'm saying that we're in a bear trend right now, technically the lower Bollinger is when you start to buy equities or options, anything again. Because that's when you get your massive bounces are from the lower Bollinger. Lower Bollinger, massive move. Bollinger, massive move. Even though this looks like consolidation, this was a very massive move for the market. It was a whole $40. Lower Bollinger, push upward again. Lower Bollinger, push upward. So generally, you do want to be buying into the lower Bollinger even if it turns into some scary sell-off, uh, usually if you have enough time and duration, you're going to be fine. Now, that isn't always the case, for example, if this is the top of, the quote-unquote AI bubble, and if we're going to be losing some value for quite a while, then that would be a totally different story. Um, Again, just with this daily time frame pulled up, we're going to show some structure we've been looking at. And we have been expecting some major selling to occur. We've had this massive cup. I'm actually going to draw it again because it's been a while. But we've had this massive cup built, and generally from the cup you expect a handle. Now, I've been kind of looking over this for a very long time, and I do think that the handle occurred right there, and I didn't catch it because it was just such a small movement. We didn't really have a very clean 20 mod test in there. It was a bounce off of the level. It didn't even last for more than an hour. So that's why I did not expect that as the major handle for this cup. We were really anticipating the handle on this cup to be a lot further. Now, with that said, that means that this structure is basically closed off, meaning that the market is now having to build structure in this new area to basically push to a new level or, head downward. Now, I have a lot of drawings here. I'm going to zoom in a second, but I just want to show these two channels is that we have the orange dotted line here. That was the previous major buying channel, and that was all the way from the last major correction back in February to April. Um, from that major correction, this buying channel has held very strongly. Um, it just broke a few sessions ago. Uh, this was an official break to the structure because this completed the bearish structure of this inverse cup. Okay, and with that structure being completed, it broke the previous buying channel. It created this massive consolidation range that has held through the previous high. We had that massive consolidation in there. We had that potential breakout, and from that breakout, we got a double top into selling. So what that's telling us is that the buying is temporarily done for right now. We have the selling channel holding its weight very well, and I am going to delete this larger head structure or head and shoulder structure right now because that's not important. That arrow, we're basically saying we anticipate a bounce right here. Again, we did close the cup on this larger inverse cup. We are still within this major consolidation channel, and I'm going to go to the 4-hour time frame here just to show this a little better. This isn't the best drawn right now, I apologize. But we're still within this consolidation channel, and from that, we close the large inverse cup, so I'm going to delete that. And from that inverse cup closing, we should be anticipating a handle. And that handle is to create the liquidity to push downward further in this selling channel and everything else. So I'm going to delete this to show that we were expecting buying. Um, I still fully expect buying almost all the way back up to the top of this consolidation channel. The main reason is that consolidation channels generally trade from the bottom to the top or the top to the bottom. With us being at the bottom of this channel, slowly starting to buy back up again, we should expect the moving averages tested in this range. And even if we don't get a full buy up to the top of the channel, um, we do know that the 20 MA is slowly starting to pull down in here. I believe it's at what, the 670? Let me just check. It's at the 674. So it's basically right at the top of this channel right now. Each trading session that goes by, that will be pulling downward. So our target is just going to continue moving downward towards us as we start buying upward towards that range. If we are, actually going to test the 20 MA. If we're going to head downward, then we are looking for a further 5 MA rejection. And from that 5 MA rejection, to break below this consolidation channel bottom. And from breaking below that consolidation channel bottom, then we can work on the next major selling structure. And that next major gap is the 646.20. So that's what it would kind of look like is a rejection from the 20 MA or from the 5 MA into the lower Bollinger, having a whole nother lower Bollinger move again, and getting this new level. So that's really what we're expecting in the current sense is either we're going to head upward towards that 20 mile and test that level, or we're going to either break away from this 5 mile to the downside or to the upside. So it's as simple as that. Look for where the market is heading from the 5 mile itself. Now, in the overnight and everything, there's a little bit of buying. Don't really focus on that. What you want to focus on is the VIX on the open. If I can actually chart here. And again, this is not the VIX. This is the VIX volatility futures. So this is tracking the actual volatility within the VIX futures. Um, this moves very aggressively up or down, whether there's buying or selling. If there's going to be selling, again, see this held above the level, excuse me, above the 98 range, and you will see massive buying into this. Okay, you won't see the price consolidating or anything. You'll be seeing it massively buying upward. Okay, this is what selling looks like on the VVIX. Okay, this is correlated directly to the SPY. Is that when you're seeing this push upward, that means that the SPY is selling off. If you see this having a massive sell-off candle like this, then that means that you're going to be seeing buying within the, with the SPY. So if you're above the 98, that means there's selling in the SPY. If you drop down to the 92, that means that very likely you're going to be seeing consolidation within these SPY levels. And if you drop to the 88 or below, then you're generally going to start seeing heavy buying. Um, that's kind of how the VVIX works. Sorry, my daughter's crying. Sorry about that. Anyway, so what I'm trying to say is that this is a very, very powerful tool when we get to key ranges. So for example, if we get to the 5 mil and you're unsure if going to be really buying or selling from that level, well, you just have to open the VVIX and it'll tell you exactly if we're going to be buying or selling from that level. If we're going to be selling, the VVIX will be buying upward. If we're going to be buying, the VVIX will be pulling down. It's as simple as that. It's one of the better tools I've used to really determine some of these key ranges, especially like the 20 mile ranges. If we're going to have a rejection off of that, um, the VVIX will tell you pretty much exactly what's going on with the price action. So really be watching this when we're trading around the 5 mile range or starting to head upward towards that 20 mile. Again, I'm really not expecting the selling to continue too much further just yet. Unless we see the 5 mile heavily rejected on um, one of the next two sessions. I really don't expect selling this week. I expect the market to um, really start heading upward and retesting some of these moving averages. And that's purely for bearish reasons. Um, you do have to retest the liquidity to the upside to continue having people open up new shorts, new put positions to increase the volatility on the upside and downside. So do need to see some of the liquidity retested to the upside. We can't just continue to continuously sell off. And a perfect example of that is when we had that major sell off back in February and April. Is that even with some of these really massive lower Bollinger moves, we were still testing the 5 mall, still coming up, retesting the 20 mall, having rejections off of the 10 mall. Um, all these levels were very, very key to pay attention to at the time because I remember we were having quite a long period of time where we were trading below the 5 mall, but above the upper Bollinger. And that just allowed the market to continue rejecting the 5 mod to the downside and allowed that selling to continue. So if that's going to happen right here, just look for the 5 mod rejection. If not, then you're just looking for the 5 mod to be retested and essentially look for that 20 mod to reshort. Um, as simple as that. I know it's really not that easy, but during the trading sessions, it will make sense if you write out the levels and are just actively looking for that. Um, Again, the market price is above the 5 mile right now as of the overnight. So your levels are very easy. Either you're going to be targeting the 10 mile, 20 mile, or you're going to be targeting the 5 mile, which is below you. Um, One of those levels are going to be targeted, and you just have to kind of figure out which one is the target. So, um, yeah, that's the SPY TA for this week. I might do some other videos this week, but again, I do kind of want to take the holiday week a little more relaxed, so I can't promise if I will be putting out any other videos this week, but I will at least try to cover the SPY technical analysis. All right, and now we're going to discuss yields, and there are some other data sets I want to pull up really quick. Not loading like I need them to load. Okay, here we are. Let's pull this up. And we're going to go over a few of these. So this first one is the Fed's balance sheet. Okay. And this is the max time frame. Um, this shows when old 2008 crisis happened, when COVID happened. You can see it shooting up massively. And from the top of COVID, it's been pulling downward. Now, we're not over the whole COVID period yet. If I could draw on here, I would draw a box right there, but we're starting to break the COVID ranges. We broke the first one, which was really that 7 trillion mark. Now we're starting to break below that, um, which really means is that we do have the ability to QE. Technically, the Fed has almost 3 trillion, not including any cash that I've I don't know about, or outside of the security sales. They have at least 3 trillion that they can inject at any time. Um, that's plenty of QE. Uh, I don't, yeah, I don't know what more to say about that. This is a really revealing chart to me, because this is telling me that from a yield perspective, that the Fed is finally starting to taper out their QT. And that means that they really want to set a level at this basically 7 million range, give or take, um, for their balance sheet. Um, and if we look at the whole 2008 crisis, basically leading up to COVID, they retained a fairly tight balance sheet between the 2 to 4 trillion mark. There was that little bit of economic crisis that happened during, 2013, 2012, and that caused basically this level at the 2 trillion mark to be pushed up to that 4 trillion mark. So really we're sitting at that 6 to 7 trillion mark for um the effective federal funds balance rate or balance sheet right now. Um why that why I'm bringing this up is because we have the jobless claims, which this is a 2-year time frame. I want to show the 5-year, but this is misleading because of COVID. As you can see throughout the max time frame, um, the continuing jobless claims, um, came down very, very quite a bit from that 2009 level, 2008, 2009. Had the massive layoffs and everything from the recession, slowly pulled down, and then COVID hit, slowly pulling down. However, going over a 2-year period, we see that this is a very, very continuous upward trend. If you were to actually just draw an actual just channel on this, it would be almost straight up channel. Um, Looks like a buying channel. So the continuing jobless claims have been rising, okay, and it's starting to get back up to that 2 million point, which is very, very dangerous. And we see a little bit of this happening within the initial jobless claims, even though it is a little misleading because of the past few months we haven't had the data. However, we're seeing massive upticks, and we, overall, this is just an upward trend. Some of the lower points, 2024 had a low point early 2025, but from then, it's been just an uptrend. It looks like it's downtrending right now, but I can promise you that is not the case. Now, um, next data point I want to get to is the US 10-year yield, and I had to draw this on my phone. I apologize. That's why it looks a little wonky. It's not on the actual Weeble chart. This is the 5-year time frame on the US 10-year Treasury yields. This is when the whole COVID ordeal was going on and when they had to really pull the rates up massively and they were selling a ton of treasuries off. Now, from those massive treasury sales and from the yields pulling downward, back upward, and slowly pulling downward again, we have formed a very strong selling channel within the actual 10-year treasury yield. And that means that we did break the previous buying channel. Um, with that major buying channel being broken, and again, this is a multiple year buying channel, that suggests that we have in fact defeated the high yields and that we are on a downtrend. Um, you know, Simple as that. Now, the SOFR rates I am bringing up because there's been the whole collateral crisis going on. Now, this is showing a period of, you know, basically from 2019 to current, and this whole chart doesn't mean a whole lot right now. What does mean a lot to us is that the last 2 months, really, we've been seeing a lot of buying within the SOFR, and we've been seeing it push closer to the upper bounds of the Fed rate. Now, the federal rate right now is between 3.75 to 4%. So anytime we start getting near that 4%, that means that people are having to very, very likely borrow above that rate, as that's just a average for the yields. You have people getting yields underneath that. You have people getting yields over that. When you see this pushing upward, that's not a good thing. That means that people are having to get collateral out of the overnight market when they previously didn't need to. And that means that a lot of back end lending and credit has really just kind of shut down. And that's why these people are having to go to the SOFR to lend from that, even at an extended uh, yield um, above the previous rate. Now, again, that was almost a month ago that we saw that massive push upward. Um, but it's still been very elevated throughout this whole time. So just be aware of that. When the interest rates are cut, you expect the SOFR, you know, to pull down as well. Now, the reason why I wanted to show this is that whenever there's these massive events, and this is during COVID, this is now, um, you see this split, and you see the SOFR being purchased during that time and being used, and you see the volume massively pick up. Now, it makes it look like the SOFR is not being used, um, because of how this chart works, but when you're seeing the split in this, this means that the volume is very, very high above the actual SOFR usage. Um, or what's really kind of anticipated. If all things are perfect, then you're going to be seeing these holding, fairly close together. Okay, you're not going to see any sort of inversion. You're not going to see um, basically this massive split between the volume and the SOFR. This is showing that there's billions and billions of volume, um, you know, while the yield is pulling down. So there's active usage in that above the yield rate. Now, this last thing I wanted to show here is the 10-year minus the 2-year Treasury rate. And this was showing how we did have the inversion, during 2022 all the way to the end of 2024. And really what this is showing is that we had our bear market, and now we're really starting to break out of that bear market. Okay. Um, that's just the way that I see it. When you have the yields inverted like that, it generally causes pretty bad things. Um, Now we're seeing yields starting to enter back to a corrective stance. And by corrective, I don't mean corrective as in a correction, but the non-inverted yields. We're seeing things pulling back to normality. And what that really means is that we should be anticipating that the yields are going to be continuing to get cut. Um, and very likely we'll continue to see this chart pulling upward, okay, as the yields come downward. Now, the last thing I want to show here is really the CME Fed futures. And I believe I showed this last Sunday where the the market was really pricing in a cut, and then all of a sudden the Fed was being very, very hawkish. The cut was really not being priced in all of a sudden. And then here we are again. The rate cut is being priced in again. So all of a sudden we went from basically having the 50 to 60% chance of it being a pause. Now they're seeing that as a 67.3% chance of a rate cut, and that would be the 25 basis point cut. So I don't believe the whole Fed hawkishness. I was saying that last week. They really were just kind of out of the box and really uncharacteristic with that. And I didn't really believe that for a second. Um, we should be seeing the uh 25 basis point cut for December. And moving into January and everything, they're starting to price in the cut below that. And that's really starting to tell you that the market is seeing rate cuts coming in fairly consecutively. That's telling you exactly that the Treasury market is seeing further yield, um, further rate cuts. And there's a misconception that people think that I believe the Fed controls the rates. Absolutely not. But the Fed does have a lot of influence on the rates, and the Fed is going to move with where the rates should be based on where the Treasury market is pricing them. If the Treasury market is pricing the yields to be cut, then the Fed will be cutting into that very, very likely. It'd be very, very surprising to see the Fed do a pause when the Treasury market is really anticipating the cut here. Um, and generally, that doesn't happen. Generally, you won't see the market go against the CME. As I said last week, we should be seeing this number increase almost every single day. Um, we had 1 or 2 days last week where the rate pulled up a whole 4%, and I said, that was really huge. If we saw that for even a full 10 to 20 sessions, that'd be a full 40 to 80% expectation in the the 25 basis point cut. So really very, very likely, unless we have super strong data come out of nowhere, we should be seeing this pull up to the 100%. Now, I am going to swap back to TLT chart and show that. Um, because again, on TLT, we have very, very, very bullish structure here. And this was that last week and a half really in TLT where we had the Fed being super, super hawkish. Really uncharacteristic. Uh, I do think that they did that to kind of break the market a little bit. See about that. But with that said, we had this inverse cup that was created. From the inverse cup, we had the handle, and from that handle, we actually did not have the breakthrough in the bottom trend of this consolidation channel. Um, so far, it's actually an upward bounce. Okay, and from that upward bounce, this is creating a double bottom, which you've heard my videos before is one of the most bullish structures out there because from double bottoms you always get the largest bounces. So really I'm expecting the buying to pick up and really fill this cup back up to the 92 range. Um, we still have a whole month and a half really on some of our contracts. I know some still have the December 31st contracts. I do as well. Um, I'm not adding to those anymore. I'm adding to the whatever the date in March is that they have available right now. But it's the March 31st 96 calls. I have it marked right here. I've been adding to these. I believe they're probably going to be around $75 a pop tomorrow. Very, very good options. But I'm really anticipating this cup to close before the end of December. Now, our price target to the 95.20, um, I do fully anticipate that, but I don't know if that's going to happen by December at this point. Um, unless we start really seeing weakening labor market uh, data coming in that really breaks us open and starts massive buying. Um, other than that, uh, just be cautious. We are going to very, very likely be pulling back up to the top of that channel. And when we do, there is the chance that we can reject back downward. Okay, so if you're in the December contracts, just be aware that that might be the time to sell. Because if we don't get the bounce to the upside, then a lot of the contract weight is going to fall off. Because we are within a consolidation channel. When we're in a consolidation channel, as always, we expect to trade from the top to the bottom and to the bottom to the top. So once we actually do close this cup, we should anticipate a small handle to form, and from that handle, we should see the breakout. Um, that could still happen within the December timeframe, but it is getting a little sketchy. Having that, the last week and a half push downward, really pushed against that time frame a little. So be aware of that. When we do push back up to that 92 range, depending on how long that takes, that might be the time to really take profit for those December contracts. With that said, um, once we do pull up to 92, this is the handle of that very large cup on the daily channel. So technically, we don't need to see a handle on the nested cup right here. Technically, that could be enough to break us out and push us up to the 95.20. We'll discuss it when we start getting towards that area a lot further. Um, but that's just something I wanted to point out to be aware of. Video's been quite a bit longer than I expected. I apologize, but we are going to very, very quickly go through Bitcoin and the DXY at least. So this is the Bitcoin daily time frame. This is yellow major buying channel that we have been in for an extremely long time, and I'm going to show this on the weekly for a moment. This weekly buying channel or this major buying channel has been in play for basically the inception of Bitcoin. It's been holding extremely, extremely long. Now, we did break through a major buying channel. That's this orange dotted line. And from that, we have started, we are within this major selling channel. Now, we talked about two ranges we could bounce at. First, it was this 90.4K. Um, Obviously that did not bounce, so we are going to delete that. And now that that did not bounce, we should expect and fully anticipate this major inverse cup to close. Um, that would fully suggest that we should be seeing close to around 12,000 more uh, Bitcoin losses. Um, I hate to say that, it's not a good thing. I know many people are Bitcoin holders, and I don't like to be the bearer of bad news. Um, But that 74.4, it's 74.4. Um, that 74.4 thousand range looks almost certain to hit. Um, I'd be extremely, extremely, extremely surprised if we don't get that move to that range. Um, we did talk about this in last week, how I would buy at the 90K. I did buy at the 90K. I am saving quite a bit of funds for that 74.4K. I would, I'm fully expecting us to get there. I can't really say that in a video because, I could get in trouble for that, but um, you know, that level is looking extremely, extremely primed. Just throughout everything in this price action, it's telling me that he wants that 74.4K. Um, I don't want to delete all the pictures on the chart. I just want the cup. As you could see, that inverse cup has been pulling down all the way to this massive chunk of liquidity right here. From this bottom, we should be expecting bullish structure. And if we start seeing bullish structure form in here, then we can start buying up to that 90K again, and then see if that becomes a major buying area again. If not, if you don't see the buying structure, then again, fully expect that to pull downward um, to finish out that inverse cup and allow that liquidity to really take in. Um, with the dollar pulling upward, and that's the DXY, again, there's quite a bit of bullish structure here. We did break through the bottom of a previous consolidation channel, which means that extremely likely we're going to trade from the bottom to the top, and I don't expect us to pull all the way up to that 107. Trust me. That's not what I'm saying at all. I do expect towards this 102 range, and then it to start pulling back downward. Um, Again, this ties in a lot with our collateral crisis that's been going on, but as long as we see major strength within the dollar, that is going to heavily weigh on equities. That's going to heavily weigh on Bitcoin. That's going to weigh on pretty much all of the markets. Um, so be aware of that. Uh, Sorry, my daughter's crying. She doesn't want to go to sleep right now. Um, yeah, just really look for what the DXY is doing. We do expect a breakout. We have this very, very well-formed up and handle. We could see a micro handle formed on this nested cup right here, but we technically have everything we need to have a full-on breakout. So That's why I've been really saying I don't think we've even really seen the major selling yet. I think that is, $2 range right here is massive for the market, and I think that's really where we see the major selling start to pick up. Other than that, again, position-wise, I am still shorting the HYG. Um, we should see continued selling in the HYG. If not, then that's very, very indicative that we will be seeing a market bounce. But if we see the continued selling, which again I fully anticipate it to happen, um, that should be very, very indicative of continued market selling. I don't really want to go over anything else because I think this video is probably over an hour now. Uh, with that said, I hope everyone has a very great week. Again, I'm not sure that I'll be posting any other further videos this week. I will try to, but not going to promise on that. Um, expect lower volume this week. We do have, you know, Thursday off, and Friday is a short day. Um, with a ton of data on Tuesday and Wednesday. So, yeah, trade cautiously, everyone. Thank you all for watching. If you've made it this far, I appreciate it. Um, thank you everyone who takes the time to like my videos, comment, share, subscribe, whatever. Um, it all helps. Thank you so, so much. Other than that, I hope everyone has a great week, great safe, and I will talk to you in the next video. Again, there won't be another video very likely until probably Friday, unless we see something major happen within the SPY or something that I feel like I need to cover. But for the most part, really, we should see slow upward consolidation throughout the rest of this week. Um, so yeah, that's the TA. That's the talk on the yields. That's everything. Yeah, I'm gonna end the video there. Take care, everybody.